Hi, this is Ken Boyd with the Accounting Accidentally website. As you can see from the home page, you can click on a link to find over 300 blog posts, and if you slide down to the middle of the page, you'll see over 400 accounting videos, mostly on accounting and some finance. What I wanted to cover today is the third of 3 videos that deal with inventory valuation. Inventory is often the largest asset on the books, and how that value is determined has a lot to do with recognizing profit. What we're going to do today is cover the third one, which is the weighted average example of valuing inventory. Now, what you'll note is that if you've watched the prior videos, this data is the same regardless of which inventory valuation method you choose. In other words, the units purchased are the same, the units sold are the same, and the cost of the units is the same, and it happens to add up to $39.25. What is different among these 3 units is how cost of sales and ending inventory are valued. And it's important to remember that the total cost of the inventory can only end up in one of 2 places. It's either cost of sales, you sold it, or it's ending inventory, which means it's still on your shelf. So weighted cost is the easiest method, because if I click on the formula, you'll see that it's simply taking the total cost to account for $39.25 in blue and dividing by the total units purchased, 325, to equal $12.08 per unit. Another quick note, we assume that we don't have any inventory at the start of the year to make the process simple. So start of October, there's 0 inventory and all the inventory is purchased. So now, we sold 100 units, and the question is, how do we value those 100 units? Well, with weighted average cost, it's easy. We simply multiply all the units we sold, 100, times 1208 to come up with the total cost based on weighted average. We add it all up, and our cost of sales is $1,208. What's left in inventory are 225 items, so 100 items sold compared to 325 purchased. There's 225 items left. We value those at $12.08. We multiply across. We add it up. It happens to be $27.17. And what you'll note is that the sum of cost of sales plus ending inventory equals the $39.25 total that we need to account for. This is the easiest method. You also saw prior videos on first in, first out, which means that the oldest, usually cheapest units are sold first, and LIFO, L-I-F-O, last in, first out, which means that the more expensive units are sold first. And this has a big impact on cost of sales and ending inventory, and it's a common CPA test question to talk about what's the impact on cost of sales, what stays in inventory, and how does it affect net income when you compare these 3 methods. That's as far as we'll get for right now. If you are studying for the CPA exam, you can join Conference Room for free. This happens to be the feed to do that. This is what the page looks like, and you'll see here that we have a new course called The 5 Biggest Topics on the FAR Test. There'll be many other courses here over time. And if you click on the events section when you join Conference Room, you'll see live courses to prepare for the CPA exam. If I open this one up a bit, you'll see the 5 topics that we cover. They're 90-minute sessions. We're going to give you Excel templates to learn. Courses start in July of 2019. Thanks very much for watching, and we'll see you next time.